The following presentation is intended for financial advisors only. This event may include statements that contain forward-looking information, and such statements may be subject to risks and uncertainties, some of which are significant in scope and by their nature beyond the controls of the investment advisor. There can be no assurance that such information will prove to be accurate, and historical results are not necessarily indicative of future performance.
Greetings. I'm Mike Hurley, Chief Market Strategist for NexPoint with your weekly market deep dive for May 24th, 2021. Well, what seemed like a pretty quiet week actually had some pretty interesting action behind the scenes. Starting with the US dollar, as we like to, you can see a longer-term monthly chart on the top left with a weekly chart to the right. You can see that the dollar is down testing really critical support in the 90 area. We've talked about this area several weeks now, and if this area breaks, it could certainly lead to a pretty significant round of inflation. That area has not broken yet, and it should be support, and we do expect an epic battle around this area in the weeks ahead. Secondly, if you look a little lower, the Bloomberg Commodity Index, the chart of copper, as well as corn at the bottom right, you can see that several of these commodities are starting to enter corrective or consolidation phases. They've been strong over the past year, which signifies reflation, which is good news for the markets as well as the economies. But entering consolidation is a normal, healthy, digestive action. Finally, if you look at the green circle, second down from the right, you can see the move in gold, which we think was pretty significant. We've been talking about gold for several weeks. Gold should do well when the government is printing tons of money and hopefully and potentially, I should say, causing inflation, as well as during periods of geopolitical instability. And with the interception of a Ryanair jet over the weekend by Belarusian MiGs, clearly geopolitical instability is on the rise. But regardless, we believe gold and silver both are verging on some pretty good moves going forward, given they've come out of three-quarter-long consolidation ranges. Looking a little deeper at both oil and gold, starting with oil on the left, not much has changed with the chart of oil. You can see that the spread between the 1-month and 12-month forward Brent contracts did narrow a little bit, but that spread is still positive or in what's called a backward configuration, which is bullish for prices. Additionally, you can see the price action is bullish. Crude has actually gotten through a downtrend, gotten through the high 50 area, which should have been an area of resistance. So again, all looks healthy in the world of crude oil. As with gold, I put some downtrends on the charts on the bottom. And even though the spreads narrowed between the 5-year break even less the 5-year and the 10-year break even less the 10-year, those spreads have been positive for several years now. And again, probably remain a wind at the back of that shiny yellow metal. As for bonds and rates, always very quiet in the yield markets or with the 10-year treasury last week. You can see on the daily chart at the top left, trading in a very narrow range. Stepping back and looking at the big picture, you can see the 10-year treasury as of the bottom last year has had a very nice rally from 1 to 1.75%. If you look at the weekly chart, the recent action does look like a bullish flag on the chart or just a garden variety orderly consolidation, meaning this is probably a very good time to tell clients to refinance that house or refinance whatever, because odds are rates will be headed higher in the weeks and months ahead. Looking at yields globally, they were mixed. If you look at the chart on the right, you can see the US was down a basis point. The 10-year US break even was down by 9 basis points. Yields in Japan, the 10-year yield in Japan was unchanged, but pretty good moves seen in both the UK as well as Germany. These moves were not only up 8 and 10 basis points, but you can see actually made new recovery highs or new cycle highs as evidenced by the orange line and the blue line. If you look at the small chart on the left, you can see the US Treasury yield curve remains in good shape. It hasn't changed much over the 1-month period based on the difference between the dark green and the olive dotted line. But over the 6 and 12-month period, there's been nice steepening in the curve, which again confirms that growth globally and growth in the economy in the US. Looking at credit spreads, or the difference between investment grade credit, high yield credit, and CCC credit compared to the US 10-year Treasury, you can see they were wider slightly on the week based on CCC and the high yield, with investment grade flat. They are at very low and mundane, tame levels, however, and not giving any sort of warning sign to equities. If you look at the value line, or a long-term look at the US stock market, you can see the value line was down by roughly 0.5% on the week. But again, looking back across the last 18 or so years, you can see several distinct market cycles. A bottom in a bull market, a bottom in 2008 and 9 in a bull market, a bottom in 2011, bull market with a bottom in 16 and 15 or 16, a bull market with a bottom in 18, short bull market interrupted by COVID, and a bull market once again. What's been remarkable about the current bull market is that the percentage of stocks trading above their 200-day has been remarkably strong. It's been above 80% for several months, and the last time we saw that type of strength was coming off the 2009, 2008 or 9 lows. So again, remarkable strength that shows a very overbought market, but overbought in a good way, because usually this surge in breadth only happens early in a bull market. Usually, as you can see here in 13 and 14, also in 16 and 17, as the bull market continues, that's when you usually see breadth diverge for quite some time before the final top is in place. Taking a little more short-term or tactical look at the markets, you can see, again, lots of action on the week, but little change in the end. And by that, I mean looking at the daily chart of the S&P 500 at the top left, you can see 2.5 days down and 2.5 days up, and you really end right where you started. Looking a little bit behind the scenes, though, however, while it's good news that the S&P held its 50-day average, you can see it so with a pretty remarkable decrease in new 52-week highs, or the number of stocks making new 52-week highs. You can also see the NASDAQ continues to see a decline in the number of new 52-week highs as well. And so because of that reason, we're saying internals continue to decay behind the scenes. You can see that as well in the weekly chart. Pardon me. As the S&P 500 weekly chart is clearly hitting higher highs and higher lows with a strong advanced decline line and strong leadership, whereas the NASDAQ is seeing a divergence in the advanced decline line or breadth, as well as a divergence in leadership. So again, the NASDAQ is far weaker than the NYSE and suggests stocks may be falling into a little further correction here in the weeks and months ahead. Finally, I've shown some risk measures here on the far right-hand side, which is a weekly chart of the copper to gold ratio, which is making a higher high, a weekly chart of the Dow Transports to Dow Utilities, higher high, and the yield curve as measured by 10-year minus 3-month spread, which is still strong and really just consolidating its recent gains. So 3 risk measures still in good shape. 3, however, are starting to crack a little bit, and again, suggest a consolidation or correction may be nearby. Specifically, if you look at the ratio of consumer discretionary stocks to consumer staple stocks, that's making a slightly lower high and has been going sideways really all year long, meaning consumer staple stocks, which are defensive in nature and where people go when they're nervous, are starting to perform better than consumer discretionary stocks. Additionally, if you look at recent performance of IPOs, after a strong run off the 2020 lows, the last several months has been weaker as measured by the Renaissance IPO ETF. Finally, we talked about Bitcoin last week and showed a daily chart here on the bottom left, and it looked like it was forming a head and shoulders top. That gave us a target for Bitcoin down around the 37, 38 area, which it hit on Wednesday, only a couple of days after we showed our brief. That target has been hit, and again, you're near an area which may provide support in that 200-day moving average, and you can see a weekly Bitcoin chart on the right. Bottom line, stocks remain in a bull market. We think it's a healthy bull market that's only about a third of the way through, but we do look set up for some consolidation or some corrective type action in the weeks and months ahead. If you look at the volatility surface, that shows the same. The volatility surface from last week was on the top left, and the week before in the center. And you can see the difference is that near dated calls were sold and near dated puts were bought, meaning people are buying protection on this market more aggressively last week than they were the week before. If we want to look at the sectors, you can also see a defensive tilt to the market. I put a red block around the table on the left, and you can see that the best performers on the week were REITs, healthcare sector, the utilities, and again, consumer staples. So consumer staples were actually up on the week, and consumer discretionary stocks lost 1.3%. So again, that's how you can tell the market has a very defensive tilt these days, in the fact that these defensive sectors are holding up when some of the more risk on or economically sensitive sectors are seeing corrections. You can also see that in the fixed income part of this table, where treasuries outperformed both investment grade bonds as well as high yield bonds. If you look at the volatility curves, you can see the same phenomenon on the bottom. If you look at the difference between call skew and put skew, real estate remains fairly wide and strong, meaning people are bidding up calls in the real estate IYR ETF and selling puts in the IYR ETF. In the energy ETF, which is again something that's been leading the market higher and more of a value play, you can see put skew, call skew correction much stronger than put skew, but the difference between them, with the green line above the red line, suggests that energy is again seeing much more support in the market than some of the other more cyclical areas. Finally, when looking at the options market on the dollar, you can see both put and call skew are both high. This suggests a very emotional trading environment. And if you think back to that first chart with the US dollar on some pretty critical support, it's no surprise that both of these are at high levels. Finally, taking a tour of some of the recent high-flying ETFs, you can see that it's a bit of a mixed picture. When you look at some of the alternative energy ETFs, meaning the wind energy ETF or FAN on the top left, compared to solar energy ETF on the top right, you can see that FAN is holding an important area of support and moving average, whereas the solar stocks have actually started to bend through them or break them slightly. The jury's out on whether solar is going to lead wind down or wind is going to hold solar up. But again, regardless of how this plays out over the next few weeks, these ETFs have definitely already seen some pretty significant corrections. So again, if you're looking to buy some wind stock ETF, this really is a good entry down here on support and being supported by a moving average. The picture is pretty similar when you look at the esports ETF, ESPO, which is again holding an area of support, compared to the ARK Innovation ETF, which is arguably breaking it. Now, again, these are, I wouldn't call to be decisive breaks, but this ETF, ARKK, has definitely declined a little bit more than just the esports ETF. So again, a little bit of a tug of war here between these high-flying ETFs, with the conclusion being several have already corrected, forming highs in early February, some in January. So they've already seen corrections for the past 3 or 4 months. Finally, we think it's pretty noteworthy that the semiconductors have yet to score a higher high this year since several weeks ago, despite this chip shortage that you're reading about in the papers. So far, this looks like, again, consolidation, a market pausing to refresh and not one forming a top. However, breaking the 220 area for the SMH would be a warning sign that this correction could get a little bit deeper. Finally, to the right are gold miners. We've been talking about gold stocks, silver stocks, and you can see the miners are also bouncing off a very important area of support. They've been in downtrend for 3 quarters, just emerging out of that downtrend. And again, we think that's a very attractive and timely chart and a great way to hedge a portfolio currently with some gold and silver miners. Finally, looking at the overseas markets, One or two things I wanted to note on the overseas markets, which do look great longer term, a lot like the US markets. You have seen some of these consolidate and correct. If you look at the green circle in the center, that's the Japanese market ETF. You can see after forming a high in January, we've pulled back quite gently in a very orderly manner to test that 100-day or 40-week moving average. Again, a garden variety bullish pullback or a correction in an ongoing bull market. The MCHI or Chinese market ETF, as well as the A shares, ASHR, are in a bit more of a mixed position. The A shares are clearly holding their 40-week moving average, whereas the MCHI, you can argue, is breaking that 40-week average. But again, I wouldn't call it decisive, and the jury's out. And it looks like these two are probably going to hold. Lastly, looking at some COVID stats as we like to do, you can see in the top left of this chart that daily reported new positive cases and deaths is down again, well off the high set early last year. One interesting and I think very positive development is the top right with the green box in B. And you can see a study published in 2020 found that individuals who were infected during the SARS outbreak in 2003 still possessed virus-specific T-cell immunity 17 years later. So the point being, this signals that humans definitely have some long-lasting immunity from prior infections. Interestingly, just below that, at box D, you can see, or surprisingly, I should say, that the weekly, or the millions of life years lost of excess mortality due to COVID this year in 2020 is about 1/3 what was lost in 2017. A huge surprise. And finally, E, which is the shaded box right below the purple square, states that a number of reports show that hospitalization numbers for children were grossly inflated in California, meaning by at least 40%. I think this is likely due to the fact that a hospital would provide funding from the government at any case that was designated in COVID. And so this is probably not just a California phenomenon, but one that probably goes across the nation. So in summary, what's important last week is that the US dollar is still down, testing this very, very important 90 area. Whether it holds or not in the weeks and months ahead will probably be the first domino to kick off some what will likely be very important trends in both commodities, interest rates, as well as stocks. Looking down the chart, you can see the Treasury market remains strong on a yield basis. Getting back through 140 was a very important development. And the Treasury market, as measured by 10-year yields, is really just digesting that gain as we speak. As for stocks remain in a bull market. It looks like the third or fourth inning of the game of a strong bull market. But about the third or fourth inning, you get a more significant of a correction. And that's what it looks like the NASDAQ has started. You can see a divergence in breadth. You can see a divergence in leadership. And again, it looks like there's a good chance this correction is ongoing. Finally, the overseas markets remain in healthy longer-term uptrends as well. Asia has been leading the globe higher. The Japanese market is really just pulling back to a natural area of support. And so far, it looks like the Chinese markets are holding support as well. I've been Mike Hurley, Chief Market Strategist for NexPoint with our weekly market deep dive for May 24th. I hope to see you next week.